Hey everybody, Julie G here. If you've been browsing homes lately, you're probably noticed some listings saying assumable mortgages. And with today's rates, that sounds like the ultimate home buyer hack. But what does it actually mean, and is it worth pursuing? Let's break it down in a way that's simple and just super practical. First, let's talk about what an assumable loan is. It's literally a loan that you as a new borrower can take over from an existing seller. Right now, rates are hovering around 6.34%, but many sellers still have loans from 2020 and 2021 with insanely low rates, some in the low twos and threes. That's half. So the natural question is, can you just take over their loan? Yes, but only certain types of mortgages allow it. The big three are FHA loans, which are usually issued for owner-occupied homes and first-time buyers, USDA loans for qualifying rural areas and small towns, and VA loans, which are primarily for residences purchased by eligible veterans or active duty service members. Conventional loans, those are usually not assumable. There's also a key VA loan detail that most people miss. A VA loan can be assumed by a non-veteran buyer. However, if that happens, the seller's VA entitlement remains tied to the loan until it's paid off. So that means that veteran can't use that benefit again until that mortgage is paid off. So that is huge for sellers to understand and just as important for buyers to know when they're negotiating. So here's why buyers love assumptions. The appeal is simple. You get the seller's low interest rate and their low monthly payment. A 2.75% payment versus a 6% payment could be hundreds of dollars a month. And assumable loans often come with fewer lender fees, which can reduce closing costs. But there's a part buyers don't think about up front. Let's talk about what's called the equity gap. That's the real deciding factor. When you assume a loan, you're not assuming the price of the home. You're assuming the remaining balance of the seller's mortgage. So the next question is, do you still have to qualify? And the answer is yes, assuming a mortgage doesn't skip the approval process. You still need income that fits the guidelines. You need a qualifying credit score and a manageable debt to income ratio. And because lenders don't handle assumptions often, the timeline can run a little bit longer than a standard transaction, maybe 45 to even 90 days. So when does an assumable mortgage make sense? It's a smart strategy when the seller's rate is far below today's rates. You can handle the equity gap, and you plan to stay long enough for the low rate to pay off for you. For sellers, advertising an assumable loan can help a listing really stand out, and it can help you get more for the property, especially in a high rate environment. Assumable mortgages are not a magic shortcut, but they can be a huge advantage when the numbers line up. If you're thinking about assuming a loan, or you're a seller wondering if your mortgage could attract more buyers, reach out. I've done a few of these. I'll help you run the numbers so you can make the smartest move possible.